Good evening. The Reserve Bank has cut the official cash rate to a record low of 1.75%. The bank's move came just hours before the federal budget.
SBS Finance editor Ricardo Goncalves is outside the Reserve Bank in Sydney. So, Ricardo, why today's cut from the RBA?
Well, Janice, one word: inflation. Last week we saw the underlying rate of inflation fall to 1.55%, and that is way below the RBA's target band of 2 to 3%. So one of the tools the RBA has is to cut interest rates to try to get spending up to get that inflation rate back up again. Now, it doesn't necessarily mean that the economy is in bad shape. Business confidence and conditions are up, the economy's growing at 3%, and that unemployment rate is at 5.7%, which isn't too bad. But we are starting to see some mixed signals. So what the Reserve Bank is trying to do is get on top of that by using this low inflationary environment to boost growth.
It's an exciting time for homeowner Melissa Deepold. She moved into a brand new house in Sydney's West a year ago.
It was fantastic to have what we imagined and dreamed on paper come to life. It was great.
Now her repayments look set to become smaller.
It just means that we can have, reduced debt and hopefully pay it off sooner, which is exactly what we're hoping to do.
If the banks do pass on the RBA's 0.25% cut in full, it means that on a $300,000 loan on a 25-year term, borrowers will save around $43 a month.
It's never been better. These are the lowest rates in memory. You've only got to go back to 2006 and the cash rate was 5.75.
For the housing market, it's more fuel on a fire that had started to lose a bit of heat.
I think that house prices will continue to lift. The hope is that the house price growth story actually spreads across Australia rather than remains in Sydney and Melbourne.
Well, the RBA noted more moderate economic growth of late and mixed labour market indicators. It said that prospects for sustainable growth in the economy, with inflation returning to target over time, would be improved by easing monetary policy at this meeting.
The Reserve Bank has really focused on the growth story for the economy, cutting from a position of strength.
The Australian dollar went into free fall, losing more than $1 immediately after the decision. The Australian share market more than doubled its lunchtime gains.
Lower rates tend to increase spending in the economy, increase economic activity and therefore increase the profit outlook for a lot of companies.
For savers, it's bad news. A 12-month fixed-term deposit of $300,000 would see annual interest decline by $750 a year.
You tighten the belt and get on with life.
But that means going without.
We'd eat in more and maybe not give gifts to our grandkids.
And in another blow, self-funded retirees relying on dividends won't be happy with ANZ's decision to cut its interim payout by 7% following a 24% fall in half-year cash profit.
And for them, a dividend cut like this, following on from other moves in big companies like BHP and Woolworths, means belt tightening.
Now, NAB was the first of the big four banks to say it will pass on that 25 basis point cut in full to its customers. It's just not going to happen just yet. It's going to take a couple of weeks, and a few of the other banks said they too will follow suit. So now the next big question is, will the RBA continue to cut interest rates? Well, there's this running joke in the finance world that RBA rate moves are like cockroaches. You don't just see one, it's usually another one around the corner. It's just a matter of when. Janice and Anton.
Thanks, Ricardo. Ricardo updating us from outside the Reserve Bank.